Great. Welcome, everybody, to Psychology of Investing presented by Sentinel Benefits. I'm Nick Previtt, the marketing specialist at Sentinel. Today's webinar will be recorded, so if you missed it or have to check out early, the recording will be sent over afterwards along with the presentation. Please hold all questions to the Q&A feature at the bottom, and we'll try to get to them at the very end of the presentation. Today's presenters are Dan Bernardo, Vice President of Financial Planning, and Brogan O'Connor, Vice President of Financial Planning. Without further ado, I want to hand it over to Dan Bernardo, and he can kick things off.
Thanks, Nick, and thanks to everybody for joining us today. I think Brogan and I are certainly excited about the opportunity to talk to all of you and hopefully provide some good insight as to kind of what we need to be thinking about as individuals and as investors. And obviously at the end, with some of the questions that I assume many of you may have, looking forward to answering some of them. But ultimately, I think the timing of this presentation is ideal. We've had an incredibly interesting start to 2022 from an investment perspective, kind of the landscape of what we've seen across the board. It's kind of had that feeling of there's really nowhere to hide right now, whether you're in stocks, bonds, everything seemed to be somewhat correlated and kind of working against us. And I think today's presentation, a lot of is to remind us that, for many years now, we've been in a situation where we've had the winds at our back. And at this point, as we flip the calendar to 2022, the wind has shifted and, it feels as if it's more in our face. And ultimately, the reason we wanted to provide this presentation today is really remind folks of how we've gotten to the point where we are and the fact that, things may not be working in our favor right now, reminding ourselves of the discipline, remaining calm, taking that deep breath, and really following the process that investing involves. So with no further ado, Brogan, if you want to flip ahead, we'll kick off kind of the presentation reminding us of really what are the keys to investment success. And when it comes to the conversations and talking to clients, I feel as if we need to somewhat bring it back to basics oftentimes, in that investment behavior primarily drives positive outcomes over the course of time. And the conversations generally, when you think of what you're concentrated on, it's the things that are out of our control. Taxes, estate planning, security selection, a lot of the stuff that we have no control over how things are going to perform are where we spend most of our time. And we forget the fact that just following a diligent process, remaining consistent, being diligent about savings, and not making emotional decisions really is what drives good behaviors, good outcomes, and good positive long-term effects. So the theme of the presentation is going to be talking about behavior, talking about discipline. And we're going to start off really the presentation just with a quick poll that each of you will be able to answer. And it basically shows 4 different investments as to how they've performed over time. And it really ties back into how a lot of us make decisions. And, in looking at, the chart here, there's 4 securities that have performed very, very differently over the course of time. And ultimately, people make decisions in different manners as to what they ultimately will select. So we're going to give it a couple seconds just to see how people that are in the chat are answering it. And as I'm watching it, it's going somewhat as predicted. So we'll just give it another 5-10 seconds. We're about halfway there in terms of the numbers. All right, a couple of you are slacking. All right, so we'll wrap it there. And ultimately, so the nature of this slide is to show that people like somewhat of consistency when it comes to their investments. So on this slide, we have, as I mentioned, 4 totally different investments. And on the chat, 60% of folks that are taking the poll selected the green option, which is certainly the same option I would have selected. It's, steady, consistent growth. But in reality, when you look at the ultimate results of how these securities performed after this, there's obviously a huge discrepancy. So you're probably asking, well, what is Fairfield Century? Fairfield Century was a seed company to Bernie Madoff's investment firm, which inevitably, as we all know, went out of business. And the reason we like to ultimately show this is when markets are going well and you're making money, you like the level of consistency of participating in those up markets and, really don't want to have the level of volatility. Ultimately, this is not a recommendation that everyone go out and put all of their money in Pfizer stock by any means. But I think it brings back to the importance of none of us know what's going to happen with any given investment, and the importance of diversification, especially in a year like 2022, is apparent that it's going to provide a little bit more of a smooth ride from point A to point B. So Brogan, if you can go just to the next slide. I think a quote from obviously one of the most famous investors ever: we don't have to be smarter than the rest. We have to be more disciplined than the rest. And oftentimes I feel like the best clients that I have, the best investors, are the ones that aren't logging into their accounts every day. They're the ones that aren't making decisions based off of headlines or short-term news. And a lot of the conversations that, Brogan and I have both had over the last couple of weeks, and really since the beginning of the year, it's all emotional driven. People have seen their portfolios come down 5, 10, 15, maybe 20%. And it's forgetting the fact that over the last 3, 5, 10 years, portfolios are up a cumulative anywhere from 50 to 100, depending where you're invested. And essentially, we've given a little back to start the year. So I think it's remember where we came from, remember how we got to the point that we're at today, stay disciplined, stay diligent, stay calm, and continue saving. And ultimately, it's going to lead to good outcomes.
Brogan, I think your sound's off.
All right. Well, thank you, Nick. So jumping into a little bit of the psychology of investing, I think everybody on the phone is here today because it's a pretty interesting topic. It's something that controls the actions that we take. Your mind controls the actions that we take based on the facts that we have and the perceived outcomes that may occur. And when it comes down to it, the main factors that a lot of us encounter, or the emotions that we encounter, have a lot to do with 1, envy, and 2, loss. And the purpose of today's presentation is to take a look at those 2 main factors of the psychology of investing and really build some discipline around the actions that we're taking and the things that we're thinking about as we go throughout our careers. I understand that each and every person on this phone call or this webinar may be at a different point in their life. Everybody has their own personal things that are going on a day-to-day basis and throughout their entire careers and then into their retirement. But there are some core foundational behaviors that we want to make sure you guys are taking a look at. And to put those behaviors into place, it's important to understand why at times you might be thinking about something else that you want to do. So jumping into envy. Envy, we kind of break it down into 3 different topics. So regret, lottery ticket effect, and miscalculating the risk. Envy is the emotion that gets us really thinking, well, what if? The other way you can look at it is you may be envious of something else that may be out there, whether it's your coworker's return was better than yours, or you were envious of a more downside protected portfolio. But that fear of missing out on the upside can always cause you to really encounter some things on the downside that you didn't think were possible. But putting all of that into perspective is how you should be allocating your retirement accounts and your investment accounts, and understanding these types of risks that you may be opening yourself up to along the way. So let's talk real life. I know a lot of us probably aren't Olympic athletes, myself included, and Dan, we haven't hit the Olympic trials and gone through the Olympic Games. But I think when you look at it in terms of how people feel and what's relative happiness really means in terms of what your expectations were and what the overall outcome was, when we take a look at the Olympic medalists, and there was a study done that gauged each medalist's happiness. What we saw was that the bronze medal winners on an overall basis were happier than their counterparts who won a silver medal in the Olympic Games. And why is that true? Well, it's most likely true because the bronze medal winners are those that finished in third place, of course. And those people were happy just to medal because maybe they had started out the final trials in 10th place and they made an effort to get back to the podium. And that's what every Olympic athlete wants. They want to get to the podium. They knew they weren't getting the gold. They just got to the bronze, they got on the podium and they were happy. Well, many instances you'll see the silver winners not as happy because they are envious of what could have been. You know, they're envious, they're regretful. Regret is a negative emotion where the bronze medal winners, they encountered probably in most instances, not all, but overall, they encountered some relief. So understanding that and understanding some emotions can guide you to really just a basic understanding of where you currently sit and your overall general happiness with the decisions that you're making. You need to have rational happiness, not something where you're saying, well, you know, I want to achieve the potential entire upside and I'm going to be as aggressive as possible, but I don't want to encounter the downside. Because if you have that in place, the way that the market works and the way your investments work, your overall happiness will not succeed because at the end of the day, your expectations are too high on both ends of the spectrum. So relating that back to really the market. And I'm sure you guys have heard the word diversification. A lot of you guys are part of our 401k plans. You've sat through education sessions in the past. And you've heard us say the word diversification. We still stick by that. We encourage everyone to have a diversified portfolio that is based on their overall risk tolerance and what their strategy is. If you're ever in a meeting with me, you're going to hear strategy, not pick this fund, it's going to be the best performing this year, then sell out of that and go into a new one. That's going to be the best performing in the following year. It's about picking a strategy and diversifying your portfolio. And really what we've seen is that works. But those that do diversify their portfolio, in many instances, throughout the years that they're invested, they may not be happy overall because they're seeing some other things where, you know, the S&P 500 is beating my overall diversified portfolio. So in shorter term periods, you're saying, well, I didn't make as much as the guy next to me because I wasn't 100% in the S&P 500, but even when the market was down, I still lost some money. Well, that's S&P envy. And what you see here on the page, this is about calculating risk. What you see on the page here is the S&P 500, the returns of that on certain time periods. You also see a diversified portfolio, which is outlined above. So the 25% US large cap, so on and so forth. When we break things out on a year by year period, it's easy for investors like yourselves and like ourselves to say, well, you know, on a year like 2009 to 2019, the S&P was up 351% over that period of time, and I was only up 220. I didn't make as much. And there's a lot of regret that goes on with that. Well, what happens when you start regretting what's going on within your investment account and you're looking at and comparing investment returns to things that actually apples to apples comparisons? Well, that regret may cause you to take some action. It may cause you to be somebody who's really trying to avoid loss or missing out on things that could have been. And we're going to talk about loss in a second. But what I want to point out here is that diversification has shown that it does work over longer periods of time. Now, on the phone, again, looking at the retirement side of things. For people's retirement accounts, we consider those long-term investments. So when we look at a long-term diversified portfolio from 2000 to 2021, if we bring this all full circle and say, what's the total return of that diversified portfolio versus the S&P 500, we're pretty much on par. So diversification can work even when it feels like we're losing. Trying to pinpoint shorter term periods of time and comparing your diversified portfolio to the best performing area. And I know that we get beat over the head with the S&P 500. It's on every financial news station when you turn on the financial news. It's not the strategy that you should be going by. And what you want to try and do is remind yourself that, hey, I'm in a portfolio that's diversified based on my needs, based on my overall understanding of what I need to do to get myself through my career, and then have the money available for me to retire. Diversification does work, and it does, at the end of the day, help us over the long term manage the overall risk that we're encountering along the way. Now let's talk a little bit about the lottery effect. And this is for my people who might want to be, jumping in between individual stocks, and, that's the best way to go about things. I think everybody would agree with me that buying lottery tickets probably isn't the best financial plan. I don't think you're taking all your money and going out and buying a bunch of scratch tickets or going down and buying the Powerball. Yes, is it fun at times? Sure. But why is it fun? Well, it's fun because you only have to pay $1 to get a lottery ticket for the chance to win millions. That overall thought process of thinking, hey, I can turn a very small investment to a really big investment, but the probability of that occurring is not very high. And I think a lot of people get that. What does this lead us to do? What does the lottery effect help us with, or what does it help us understand? Well, it helps us understand that the probability and possibility of hitting grand slam home runs year in and year out and creating some sort of multi-million-dollar, billion-dollar investment probably isn't the way that we want to go about living our day-to-day life, especially when it comes to our retirement accounts. Investing in particularly individual single stocks, trying to find the next great company and trying to find the hot investment trends is, of course, something that we're shown whenever you go on social media, whenever you go onto the news, you're going to see these big billionaires. You have to tone a lot of that out. You have to stick with the understanding that this is a long-term account and that you have to put the right behaviors into place. Consistently investing, I think, through your guys' 401ks or 403bs, your dollar cost averaging, and also not taking action to continuously change and go through this fund to that fund to the next fund to the following fund. You want to make sure, again, that you're sticking with a strategy, because trying to hit grand slams each time you put money into the market is not highly probable. And getting the realization and the awareness of that and understanding that, hey, I'm going to put myself in an appropriate position. It may not result in $5,000 or 5,000% return, but it's going to give me the appropriate runway to get myself through my career and into my retirement. Now, when we look at individual stock versus U.S. stock mutual funds, for those of you in 401k plans, you will have access to, through your 401k plan, mutual funds or groups of investments, groups of stocks, groups of bonds. For those of you that think that picking individual U.S. stocks is going to be the best way and that you're always going to turn out on the better side of things, just take a look at these two circles. So U.S. stocks are up on average 18.5% over the last 5 years. Over that period of time, 67% of all stocks available have returned a positive net return. 33% of them have actually lost money over the last 5 years of stocks available. 99.9% of mutual funds, equity mutual funds, have returned a positive return. 0.1% of them have lost money. So when you get caught up in the lottery effect and trying to pick the individual company that's going to perform the best, what you can actually do is put yourself and expose yourself to more risk. So we do, and that's why you have mutual funds available to you in your 401k plan. We do encourage you guys to create a portfolio and a diversified portfolio at that with the mutual funds that are available. Try and get the lottery effect out of the way. Of course, if you want to go buy a scratch ticket or you want to go buy a Powerball ticket, then that's great. But when it comes to your guys' 401k plans and putting the best practice, best behaviors into place, creating that diversified portfolio with the expectations and the appropriate expectations of over time seeing some general and nice overall growth, we think that that might be the best way to move about and move forward when it comes to your investment allocations. Now, do we really know how severe the risk can be? This is a continuation of if you are picking individual securities. This is why we try to encourage you guys to not concentrate your portfolio. And you've probably heard the term or the phrase, don't put all your eggs in one basket. And why do we say that? Well, when we look at individual stocks, and you guys can turn on the news and see it, they do have more wild swings. Equity positions can have bigger ups and downs because you're focusing on one company at a time. Well, this is all a big math game, and it incorporates percentages. And percentages can sometimes be confusing. And what you see here, if I asked everybody, well, if you had $1 today and you lost 50% of it, you're down to 50 cents. How much do you need to get back to even? Well, it's not 50%, it's 100. You need to encounter and see two times the loss on the upside. And that number only grows more significantly when you see bigger downfalls or bigger drawbacks. Now, with a diversified portfolio, as you saw on the previous slide, the possibility of encountering these downturns is really not as likely. So again, we're looking to not ride the entire huge range of individual stock positions, and we're looking more towards encouraging you guys to create that diversified portfolio to ride more of a tighter range. And of course, we're looking for a nice positive trajectory. But again, this might be something where you see your friend down the street saying, hey, you know, I found this great new biotech company. I'm going to put all my money in it. With your retirement accounts and with your investment accounts, we would encourage you guys to be more broad-based. Try to take that lottery effect out of the equation. Try and take some of that envy you might have to see those bigger returns, and really bring it back home and say, you know what, this is what my appropriate allocation is for me, no matter really what's going on in the market, and I'm going to stick with that. Now let's move on to loss. Nobody likes loss, from wherever the term may start. But what we see is, and I understand loss aversion, nobody wants to be a part of it, seeing their market or seeing their account value go down. But trying to avoid loss causes us to take a lot of different actions, and taking action being one of them, but also things like sideline sitting and following the herd. One thing that I found was actually a great kind of metaphor for trying to get out of the way or trying to do something because you're worried about loss, actually comes from being a goalkeeper in soccer and actually standing up against the penalty kick. So if there's a goalie in soccer and the other team has a penalty kick, the goalie's standing in a pretty large net. And what that goalie most of the time decides he's going to do is take action. He's going to guess. He's going to say, I'm going to go one way, I'm going left, or I'm going right. When actually probability statistics show us that his best chance is to stay there. And even though they know that, they're still diving to the left and the right. There's a general and natural tendency for us to take action when we're trying to avoid loss. And really what we're trying to do is have you guys take a step back. And I've told a lot of my clients this. I've told multiple clients, we need to take a step back and we need to look at it in a realistic perspective. Because taking action can sometimes, and many times, can cause you to do harm that you didn't think you were going to do to yourself. It's not as beneficial as you thought. Taking action may have put you in a worse situation than ensuring that, you know what, the probability and possibility of success is much better if I don't. So let's jump up to time in the market versus timing the market. So this brings us to a little bit of day trading or a little bit of market timing. And if you've been part of presentations in the past that I've done, I've shown this diagram. So missing out on top performing days. And if you were watching CNBC the other day, somebody actually mentioned this because we are, as Dan mentioned, in a pretty tough time when it comes to general markets. A hypothetical investment of $100,000 in the S&P 500 index over the last 20 years, so a long period of time. Just staying invested, you can see what your ending value would look like. Pretty nice investment for putting $100,000 in. If you miss the best 5 days, the best 15 days, and the best 25 days, you can see how that can really hurt your overall portfolio. So trying to fix your investment portfolio because the market's going down can ultimately lead you to missing out on some of the really good days within the market, and can overall, at the end of the day, hurt your ending balance as you go into your retirement and as you go through your retirement. So I'm not sitting here telling you guys that everybody needs to jump into the S&P 500 and just power on through. That's not what I recommend. What I do recommend is that you guys put a strategy into place, as I said before, and stick with it through the ups and the downs. If you're in a more aggressive strategy, you will participate in the upside of the market when markets are good. But likewise, on the other side, you will go through some market downturns, as we're going through right now, as we went through in 2020, as we went through at the end of 2018. You're going to have to weather some of those storms. But taking action because you're worried and at risk of loss just to take action isn't the right way to go about this. The one thing I will say, because we're saying don't take action. Well, if you're somebody on the call here who's maybe a little bit older and you're approaching retirement and you're 100% equity, and that's not something that you thought you were in or you were worried about that, you can always readjust and reassess. You're not taking all your money out and saying, I'm done with this. You know, what you are doing is taking the appropriate action to say, is this appropriate for me? Is this portfolio the right portfolio for me with the goals that I have and the things that I need to do throughout my career and into my retirement to be successful? So this is more about remaining invested as compared to trying to do exactly what we see here, waiting for the right time to invest. If you try and day trade or time the market, I've yet to see it done appropriately, and I can tell you if people knew how to do it, you'd never have to work again. But that's the reason, is nobody knows how to. The market is in some ways unpredictable. And over the last couple of years here, you know, there's been a lot of things going on, as there always are in this world economy and in the world as a whole. I've heard many a times, well, I'm just going to sit back and I'm going to take my money out. It's in a safe place and I'm going to jump back into the market when things are good. And I'm just really worried about the loss that I might take. Well, I can tell you one of the easiest things to do is to hit that button to say, all right, I'm out, I'm going into cash. And one of the hardest things to do is to hit those buttons and put that money back into the market, because you never know when the right time to invest is. And in many ways, it can leave you behind. This is about time in the market, not timing the market. I'm sure you guys have heard that phrase before. So just trying to avoid loss can sometimes put you in the position where you are taking these actions. You're putting these behaviors first because it's an immediate thing that makes you feel good about it. I always recommend, whatever it may be, if you are fearful of what's going on and you're worried about what's going on, and Dan's going to talk about this, well, how do you build some discipline? You have some conversations before you immediately take action, because there's certainly times that you can calm yourself down, take a deep breath, and understand that, hey, I'm not using all this money tomorrow, but I'm going to continue to put things into place to make myself comfortable with what is going on within the market. Be fearful when others are greedy, be greedy when others are fearful. There's another Warren Buffett quote. I guess we love Warren Buffett, but it really does make sense. And this doesn't have to be, I'm a really great investor and I'm going to drop a ton of money in the market when everybody's, hair's on fire and the market's, down 3%. This relays back to the question that we've been getting consistently as well with, should I stop my contributions to my 401k plan? Should I reduce them? And our answer is always, unless things have dramatically changed in your life and you've lost your job or your spouse has lost your job and you need that excess money, we would always encourage you to continue to put money in the market. One of the best things for 401k plans, or about 401k plans, is that you're dollar cost averaging into the market every time you get paid. So right now, where the market's a little bit lower, well, maybe in the future when the market's higher, you realize that, hey, at that point in time, I continue to put money in. When others were fearful at that point and they said, I'm not putting anything else in there, it's just going down, you were the individual who was going through and saying, you know what, I'm still saving, I'm still investing. I got a 15-year period, I got a 10-year period. That's a long period of time. I'm going to continue to put my money in. I'm going to continue the correct behaviors moving forward, because that's what's going to work out at the end of the day. So I'm going to throw it back over to Dan. to talk to you a little bit about how to build discipline. And I think that what he's going to tell you is really, really important when it comes to putting together the best type of plan for you. Maybe not on paper, maybe it's on paper, or maybe it's just the things that you're thinking about and the resources that you need to access to be able to put everything into perspective. So Dan, I'm going to toss back over to you.
Yeah, thanks, Brogan. I'll bring us home here, folks, in terms of building discipline and kind of building off of a lot of what Brogan just talked about. And, ultimately, I think, in the world that we're in right now, oftentimes, we have a difficult time getting out of our own way. In talking to clients and talking to 401k participants over these last couple of months, the way in which we make decisions and the way in which we ultimately choose to manage our investments oftentimes makes absolutely zero sense in terms of the comments I hear, the questions that are asked. And, in terms of clients asking me, the market seems a little crazy right now. Why haven't you reached out to me? Why haven't you, recommended any changes? And really going back to that slide that I think is perfect, being the goalie, is in reality, sometimes the best thing to do is nothing. It's continuing on the path. You built a strategy. You elected to invest your money in a certain manner at a point in time that you deemed a good decision. And when things are going well, if I were to recommend to clients that, you should probably take some risk off the table, we've seen some significant gains. People are greedy and people don't want to make changes when things are working in their favor. And every single time we see volatility along the way, whether it was December of 2018, when interest rates shot up and the market plunged 10, 15% right around the holidays, the phones start ringing. What do we do? When COVID happened, I mean, could you imagine in April 1st of 2020, recommending to a client that you take some risk off the table because the world shut down and we don't know what this future is going to look like? Well, they would have missed out on one of the biggest market rallies in the history of the market. So in terms of trying to time things, it's absolutely impossible. And as much as we like to try to make blunt decisions because we think it's the right decision, more often than not, you're going to get it wrong. And from a disciplined approach, whether you do it on your own or you choose to talk to a financial professional, I think you have to not only be honest in the discussions with the financial professional, but you have to have a very good sense of self-awareness, and you have to be honest with yourself. And I think what I mean by that is when things are going well and things are smooth, everybody is comfortable taking risk. Everyone's an aggressive investor. Why wouldn't you be? From 2019 to the end of 2021, the S&P 500 was up a cumulative almost exactly 100%. So on a 3-year rolling basis, the market averaged about 33%. And going back to Brogan's point, hopefully nobody just has all of their money in the S&P 500. You're going to have some level of diversification. But as investors, we don't think about that 100% return that happened over a 3-year period. We think about that 12% drawdown that we've seen since January 1st. And that really is just that short-term effect. What have things done for me lately? Not how did I get to where I am today? And oftentimes it's by being diligent from a savings aspect and sticking to a strategy and following the process. So in talking to the financial professional, I think the biggest thing I can say is you have to be brutally honest with yourself in terms of, can you stomach a 10, 20, 30% drawdown on a portfolio? Because I think in reality, a lot of us can't. A lot of us see the account balance dwindling and ultimately force themselves to making decisions. We're seeing that here in the first half of 2022. And Brogan and myself, we can't tell you if things are going to get worse before they get better. But, just using very short-term metrics, you look at this week, Monday, we had a little bit of a bounce in the market. Yesterday, we gave, one of the biggest declines going back to 2020. And today, unless anything changed, I think the market was up over 1% before we got on this call. And people look at things daily. And I think from a discipline standpoint, it all goes back to the level of access we have leads to a lot of bad decisions. And what I mean by that is by me pressing a button on my phone, I can see my total financial picture and I can see on a day-to-day basis whether things are good or bad. In a lot of instances, I think that's one of the worst things that we can have, is the access to seeing and monitoring things so often and so frequently, when in reality, if you look over the history of the market, there was a point in time when people invested in 401k plans where they didn't even know on a daily basis how much they had, because they only got one annual statement at the end of the year that told them whether they were up or down. And oftentimes, I think that is almost one of the best solutions, because it eliminates that need or ability to make blunt decisions or emotional decisions that can cause extreme harm to a long-term investment. So to kind of put things into context here on the next slide, this gives a pretty good representation of really what we experience by being investors. So whether you're aggressive, fairly balanced, middle of the road, if you're sitting in cash, obviously you're not going to have the roller coaster effect. But for 13 years, we've seen just a very, very bull market that hasn't had a ton of volatility. Yes, there has been years since 2008 where the market's down, but it hasn't been significant. If you've stayed invested, you're well ahead in terms of where you started. But now we're kind of turning that corner a little bit. And I would probably, if I had to peg us on this chart somewhere, it would probably fall somewhere around that nervous range. Like I said, it seems as if we've seen extreme volatility this year, but in reality, the market's only down about 10% looking at the broad US market. If you get a little bit more concentrated and say you're more growth tilted in the NASDAQ, yeah, you're down 20 to 25%, but you also have to account for the fact that over the last 5 years, you're up about 300%. But again, it goes back to the lack of discipline of us thinking, well, what has it done for me lately? So in looking at this, we all know markets go up, markets go down. At the onset of any relationship that me and Brogan have with a client, there's always the discussion about strategy, risk tolerance, and there's risk tolerance questionnaires out there. But in reality, I don't see them as being very valuable, because if you were to fill one out on December 31st of 2021, after the market went up 20%, you're probably going to say, yeah, I'm very comfortable taking risk because I just earned 12% on my portfolio over the last 12 months. But if you fill out that same risk profile questionnaire yesterday at 3:30, when the Dow Jones is down 850 points, you're answering it in two different manners. So I think the reality is you have to understand that investing is a process. Here in New England, I know the Bill Belichick quote is, do your job, follow the process. And that's really what investing is. And you have to take the good with the bad. And ultimately, right now, we're in an environment where this year, unless you have all your money in gold or you're a commodities trader, which really none of us fall in either camp, fixed income and equities are not working. And things are going to change. Things are going to improve. We've gone through some of the darkest days, even in recent times. And going back to the quote that Brogan had of, be fearful when others are greedy and vice versa, is the rich get richer in the darkest of times. When people are moving their 401k to a stable value fund because they lost 10% of their portfolio, at that same time, there's institutional investors that are putting millions of dollars into the S&P 500 or into equities when things couldn't be darker. And ultimately, that's the effect that continuously happens time in and time out of no matter what it is. I think what we always tell ourselves is, well, this time could be different. This could be the end. And somehow over the history of the market, in the darkest of times, the biggest unknowns, I think COVID is the most obvious. The world was shut down. We had no idea what was going to happen. And here we are in a much better place than where we were in March and April of 2020. So I think this slide just represents a very good example of how you're going to feel, what you're going to experience through the investment time horizon. And to Brogan's point, you don't necessarily need to be afraid to make changes. Changes can oftentimes be good, but when things are falling south, generally is not the time to totally move away from the strategy that made sense when you elected it. And, it doesn't necessarily always have that V-shaped effect that we saw in 2020. Sometimes it can be a longer road to recovery, but, as we've seen, markets have always hit new historical highs. Although you can't use the word guarantee, we generally end up in a better place than we were. Now, the really last component I wanted to focus on, and I think this in reality is probably the biggest effect. I mentioned earlier, how quickly you have access to view your account balances. But also, I think the media, the headlines, what we see day in and day out, if you're watching the national news, there's not many days where you're going to walk away from that TV saying, I am so optimistic, because everything that you see, everything that you hear has somewhat of a negative or depressing tone to it, whether it's inflation skyrocketing, supply chains breaking, Russia invading Ukraine. There's nothing but negativity. And, to put into reality, so back a year ago, 45% of Wall Street experts were wrong in guessing whether or not interest rates would go up or down. So in the reality, experts were less likely than a coin flip to pick the right decision. So I think the message here is none of us know exactly what's going to happen in the coming months, in the coming years, but over time, if you follow the process and remain diligent and remain disciplined, we're going to end up in a better place. And to really wrap things up, to kind of summarize today's call, I think the message is obvious that, although things have not been overly favorable here in 2022, there's a reason that, we're not banging down the doors, begging you to make decisions and begging you to make changes, because in reality, this is all part of a long-term process and really a long-term strategy. And, unless you're just grossly misallocated or invested inappropriately, if you've worked with an advisor or you've built a plan and you have a strategy that makes sense for you, there's buckets of those portfolios that are ultimately designed for short-term needs, maybe more intermediate-term needs, and then longer-term needs. But yet the focus remains on that overall account balance. And I think you got to try to shift your mindset to the fact that every day you log into your account, it's not going to be a consistent upward trend, nor should it be. Ultimately, you have to take risks to, be rewarded. So going to the common investor biases, I think Brogan did a great job in terms of covering the various examples. I think the fear of missing out is number one. And then really ultimately on the loss side, timing the market is something that none of us can do. As much as we think we're investment experts, as much as you could have said, well, Russia's invading Ukraine, that's really going to have a negative effect on the market. If you look historically, every major geopolitical event that has happened has been a very short-term effect on any market, and it's never really been that significant. So it's just the mindset of, well, this hasn't happened before, this one could be different. We can tell that to ourselves day in and day out, but more often than not, staying diversified, staying invested, staying in the market, and staying diligent about the process is really what drives results. And then going back to the financial professional, you got to be critical of yourself, be critical of an advisor. If someone's reaching out to you, telling you you need to move to cash because the market's fallen, I certainly don't think that's good advice. Can you take risk off the table at certain times? Absolutely. But generally, you should be looking at that in up markets, not necessarily in down markets. You got to take the good with the bad. And really, it goes back to the point that oftentimes where money is made is when things don't seem very opportunistic or very optimistic. So with that said, to wrap up before we jump into the questions, I think the reality of the messages to everything we talked about today is control the controllables and really focus on things that are more important than what our account balances are. When you see negative headlines, the next action item should not be to log into the 401k to look at your Q1 statement. I can tell all of you, if you are exposed to the market, it's certainly not overly pretty. But it's also not life-ending either. So I think keep saving, keep investing, make diligent decisions, and really focus on the things that are a little bit more important in life. So I'm going to wrap up. I don't know if Brogan has anything that he'd like to add, but I'm going to open up the questions.
I guess I can tackle the first one here, which is, what is your opinion on front-loading 401k contributions versus paying in evenly throughout the year? Front-loading. Now, of course, if things fit into your budget in terms of how you're doing things, and you need to say you wanted to front load because you knew you needed more of your paycheck in the future, or something along those lines where it was a little bit kind of unique to you, I'd say sure, front load. But if you front load, you can ultimately see you're either 100% wrong or 100% right at the end of the day. I do, when it comes to retirement accounts, one thing that I really like, and I said it earlier in the presentation, is the fact that you are kind of putting money in over time. It eliminates that guess factor. It eliminates the some of the risk of potential loss, but it can produce more return. But you don't know what's going to occur in the future. So usually when it comes down to it, we have seen people utilize the consistent contributions via their paycheck throughout their entire career. But again, I can see if you wanted to front load, you wanted to get everything in one shot, and that was convenient for you and your personal situation, then of course you can do that.
Yeah, the only thing I think I would add to that is when it comes to the front loading discussion on the 401k, just making sure you understand how the benefits work. If your company has any type of matching contribution, there are some times where, if a company matches on a per pay period basis, if you max out your contribution in the first or second quarter and are no longer contributing for the remainder of the year, you may miss out on those matching dollars if the company doesn't have a true up. So just be understanding of that. But, certainly in a year like this, if clients had the cash flow, I would say, really starting to pump money into the account when things are down certainly makes some sense. But, as we all know, markets can continue to go down a little bit. So dollar cost averaging could potentially be the outcome. The next question is as a recession around the corner, is it good time to invest in the market if one has money to invest? I really think that ultimately comes down to what's that money for. If you look at things in terms of whether or not we're going to go into a recession, I would say it very well is a high probability based on the fact of what's going on with inflation and interest rates, and really the Fed struggling to kind of control that. But if it's a short term, if you're buying a house in a year from now and you're looking to invest, I would say it's not the right decision to put money in the market and hope for the best over that period of time. If you can be understanding and disciplined that, you have money sitting in savings that you want to put to work and you really don't need access to it for 3, 5, 10 years, then yes, I would argue that it is a good time to start dollar cost averaging. I probably wouldn't, hit the buy button today and go all in, but over the next couple of months, systematically invest in and start a position and build it. And over time, obviously, things right now, or if the S&P is 12% off its high from the beginning of the year, the NASDAQ's 20 to 25% off its high from the beginning of the year. So when you look at it from a longer term approach, markets have always hit all-time highs. So I would argue that it very much so is a good time to at least start the process of getting into the market.
Yeah, I think that's I've actually had this conversation twice over the last month. So to Dan's point, if somebody doesn't ask you what the intent of the money or what's the goal with this money, I think they might be doing you a disservice, because of course, things have been good. And we went through an entire presentation about things in terms of market returns have been good. But if it's something that's a shorter term thing where you need that money, well, would we recommend that you take $200,000 and drop it into the S&P 500 or even into an aggressive portfolio today if you need it in November? I would assume we would not. So it's really about the overall understanding of what that money is used for and the time horizon at the end of the day that you are able to work with.
So it looks like one of the last questions, it's regarding, I don't know if everyone, probably not everyone's aware of it, but Fidelity came out in the last couple of days and basically outlined that by the end of the year, they plan to have cryptocurrency available within retirement plans. And basically, the question is related to whether or not that's going to become widespread in the future and whether or not it's worth having some level of allocation. And, this would lead to a ton of debate and discussion. I guess I will give my opinion on it that, if you're talking a 1 or a 2% allocation to cryptocurrency, I certainly would create the argument that it could be a very good diversifier and that it can be a very good investment. There's obviously people out there that will say, cryptocurrency is a fad. It's not something that's real. But when you have institutional money in institutions like BlackRock and Fidelity that are really backing the future of cryptocurrency, it's not going anywhere. So the one thing I would say is, proceed with caution. If you need the money 3, 6, 12 months from now, I can't promise you that it's going to be a home run investment or it's even going to provide a positive return. But going back to following the process from a long-term standpoint, I would say that, having a small allocation is not going to provide great harm, but it can be a nice diversifier within a broad portfolio. All right, so one more question. I'm within 10 years of retirement. What are the options for a Roth IRA? Do I have a choice of what I'd invest that in? So ultimately, a Roth IRA, you got to be aware of kind of the income limitations as to whether or not you can contribute to one. Many 401k plans also have the option of saving in an after-tax basis as well. But for someone that's within 10 years of retirement, I would say you certainly can still take advantage by contributing after-tax money into that Roth account. But how I would probably position that in your financial plan is the biggest benefit to having a Roth account, which provides tax-free distributions in the future, would be to delay any type of distributions to the latter years of retirement because time is the most valuable asset when it comes to Roth. So I haven't seen anything else come in. I guess we can give it a couple seconds if there's any final questions. But definitely appreciate everyone joining us today. Hopefully it was valuable. Hopefully it was somewhat of a kind of reminder that, things are not working for us at the moment. Things will get better. Stop logging into your accounts on a daily basis, focus on the strategy that's in place, and really just try to stay calm and focus on some other things. Thank you, everybody.